Imagine this. You're 60, glancing at your portfolio during a quiet evening, and a sudden market dip sends your heart racing. What if that nest egg, built through sweat and sacrifice, crumbles just as you're eyeing retirement? I've witnessed it destroy lives, diligent savers blindsided by crashes, bad bets, or greedy advice. But hold on. Today, I cut straight to the chase. If you're over 60, ignore the Wall Street spin. I'll unveil the only 3 investments I deem unbreakable, guarding your principal like Fort Knox, churning out ironclad income, and offering instant access when chaos strikes. No hype, no maybes. These are battle-tested, data-backed fortresses for your stage of life. Dive in, and you'll emerge with a blueprint for unbreakable security. Hitting 60 rewires investing overnight. The aggressive tactics that multiplied wealth in your prime, they're now ticking bombs. With a shrinking timeline, bounces that took years become impossible without a salary safety net. Every fluctuation hits harder when savings fund your freedom. Over decades, I've seen winners from their working years falter here, gripping volatile assets that plummet at the worst hour, or diving into yield traps that implode. They fall for advisors, hawking commission-driven schemes, sacrificing retirement tranquility, family legacies, and self-respect. Shift gears now, or face irreversible regret. Safety isn't optional. It's survival. Safe gets twisted in finance. Brokers peddle junk bonds as secure for their coupons, annuities as guaranteed despite hidden locks, or blue-chip stocks as reliable until dividends vanish. Real safety demands a trifecta. Zero principal erosion. Your base endures markets, recessions, geopolitics. Bulletproof income. No interruptions, no reductions. Total liquidity. Grab funds penalty-free for surprises like health scares or opportunities. Few options nail all 3. Bonds flop on rate spikes, causing value dives. Stocks halt payouts in slumps. Annuities impose surrender hits. Property, tough to liquidate, vulnerable to bubbles. True havens are scarce, but over 60, they're non-negotiable for navigating life's uncertainties. Picture this nightmare. Alex, 61, retired with $2.1 million, convinced he was golden. His planner touted a moderate setup, 55% equities for longevity. Then the 2018 volatility storm hit. Portfolio shredded 28%, down to $1.5 million. Alex, unaccustomed to such pain, bailed at the nadir, cementing losses. He bypassed the upswing, shifting to ultra-conservative holds that barely beat inflation. Now, 68, he's rationing joys, foregoing trips, skimping on gifts, tormented by eroded dreams. Alex's plight echoes thousands, career triumphs undone by age-blind risk. Or consider Maria, 62, and her partner with $1.6 million amassed. Advisors steered them to growth-oriented bonds and stocks. The 2000 dot-com bust? Wait, fast forward to 2022 inflation rout. They bled $600,000. Her partner, a dedicated mechanic, crumbled under the strain, health failing fatally by 65. Maria confided in a letter, "Growth was a lie. We craved certainty, lost our foundation, then him. Industry enablers amplify agony, bombarding with ads for labyrinthine products, variable annuities with decade-long ties, high-yield vehicles masking volatility, esoteric alts breeding confusion. They thrive on fear, opacity, and your vulnerability, seldom spotlighting straightforward shields that truly deliver. Enough horror. Here's the armor. First, short-term US Treasury securities, T-bills, maturing under 12 months, and notes, 1 to 3 years. The pinnacle of security, bar none. Lending to the federal government taps unmatched might, taxation authority, and currency creation. Default risk? 0. Imaginable scenarios like asteroids or alien invasions aside, history affirms it. Through the 1812 war, 1860s civil strife, 1930s depression, 1940s World War II, 1970s oil shocks, 1987 crash, 2001 terror, 2008 meltdown, 2020 pandemic. Treasuries paid full, on schedule, for 240 plus years. Debt scaremongers cite $35 trillion figures, but obligations in dollars mean the Fed can always settle. It's inflation worry, not solvency, and short terms minimize that, as holdings roll over quickly. Why short duration only? Long bonds invite rate risk carnage. A 2% rate jump can gut 30-year values by 25 to 35%, as in 2021 to 2022's bloodbath. Shorts shrug it off. Minimal price swings, full par at maturity. Yield trade-off, worth it for iron safety. Current rates, 4.2 to 5.1%. A retiree bonanza after zero-yield purgatory. For $1 million, that's $42,000 to $51,000 yearly, principal intact. Dedicate 45 to 55% here as your unshakable core. Acquire via treasurydirect.gov, fee-free, or ETFs like BIL or VGSH for ease. Drill down. A $10,000 6-month T-bill at 4.8% costs approximately $9,765 upfront. Redeems $10,000 exactly. No variables, no drama. Maturity options. Spend, reinvest at prevailing rates, or redirect. Ladder smartly. Divide into quarters, maturing quarterly, for perpetual liquidity and yield optimization. Say $200,000 total, $50,000 each at 3, 6, 9, 12 months. As each rolls, reinvest or tap. This setup fortifies income streams, adapts to rate shifts, and ensures funds flow without market meddling. Second powerhouse, low-cost S&P 500 index fund. Stocks volatile, absolutely short-term. 50% plus plunges like 2008 or 2022 terrify. But zoom out, over 10 to 15 to 20 years, returns always positive, averaging 10% annualized historically. At 60, actuarial tables grant 25 to 35 years. Many hit 90s. Thus, funds not needed soon thrive here, as recoveries are inevitable. Why S&P specifically? It captures America's top 500 firms. Diversified bet on capitalism's engine, not fragile singles. Icons flop, WorldCom, Bear Stearns, zeroed out. But the index, self-healing, drops laggards, adds risers like tech disruptors. Actives, 92% trail over decades, fees eroding edges. Vanguard's VFIAX, or SPYETF, costs near zero, performance pure. Commit 25 to 40% for growth armor against inflation stealth theft. It's your air booster too. Compounding turns modest sums epic. Discipline reigns. Hold amid turmoil. Recall 2009, nadir S&P at 666, fear rampant. Holders soared to 1,500 by 2013, 3,000 by 2020, 5,500 plus now. 2020's 34% freefall, rebounded in 6 months to records, or 1987's Black Monday 22% drop, recouped in 2 years. If panic-prone, trim allocation, self-assess ruthlessly. Numbers sing, $10,000 in 1970. $1.8 million today. Dividends reinvested. Inflation adjusted, still massive gains. No other class rivals this longevity wealth machine. Third pillar, cash in FDIC, insured savings, or Treasury money markets. Mundane, masterful. Pure liquidity for roofs, ER visits, weddings, zero sales stress. It's your Zen buffer. 9 to 24 months expenses parked. Let's markets rage unchecked. Yields hit 4.3 to 5.2% now. Liquid gold versus prior pennies. FDIC caps $250,000 per account. Multi-bank or funds like VMFXX for boundless government backing. Avoid CDs penalties. Opt for high-yield accounts from Ally or Capital One. Shop rates weekly. Synergy. These trio form an impenetrable vault. Treasuries, steady yield base. S&P, long-haul expander. Cash, instant shield. For $1 million sample, $500,000 treasuries, $22,000 to $26,000 income, $300,000 S&P appreciation, $200,000 cash, 1.5 to 3 years buffer. Total, $25,000 plus annual flow, plus dividends, with upside. Customize, pension rich, boost stocks, health fragile, swell cash, 65 plus, lean conservative, inflation hawk, tilt equities, counter arguments, forfeit upside. Yes, but dodge downsides. Crashes won't have you. Preservation trumps speculation post-60. Inflation erosion. Shorts adjust rates upward. Stocks outpace CPI historically, 7% versus 3%. Crave more yield. Explore blue chip dividends cautiously, or principal draws, 4% rule, or side hustles, not junk bonds or MLPs that backfire spectacularly, as in 2015 oil rout. Heirs first, true legacy, independence, not dependency. Risky bets could beggar you, burdening them. Mindset finale. Brokers breed greed via FOMO pitches. Tune out, you've conquered accumulation. Now master protection. Blissful 60-plus lives stem from worry-free finances, streamlined holdings, predictable inflows, market indifference. These three grant that: security for needs, elasticity for curveballs, growth for endurance. They're not flashy, but flawless. Embrace them. Redirect energy to passions, kin, adventures. Your fortunes fortified. Seize the horizon.